Well, good morning, everyone. It is 10 a.m. and we will call the November 13th, 2025 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 is items from the chairman. Item 2A is a resolution of appreciation for Doug Dowler for his dedicated service to the ERS. I'll ask the secretary to read the resolution.
Okay. Whereas the Oklahoma City Employee Retirement System and the Board of Trustees was established by Ordinance Number 8169 in January 1958 and was tasked with administering the retirement fund. And whereas Doug served the City of Oklahoma City for 28 years and will retire as Assistant Finance Director on December 4, 2025. And whereas Doug was elected as a trustee of the Oklahoma City Employee Retirement System in July 2023. And whereas Doug has been a conscientious fiduciary to the Oklahoma City Employee Retirement System and Oklahoma City Employees Pension Fund. And now, therefore, be it resolved by the trustees of the Oklahoma City Employee Retirement System that they do hereby recognize the contributions of Doug Dowler for his professionalism, dedication, and service to the Oklahoma City Employee Retirement System.
Okay, Doug, as you can see, is not with us this morning. He is traveling. I can't believe he would not want to be here. But anyway, we will make sure he gets the signed copy of this. And with that, Chair will entertain a motion to approve the resolution. We have a motion and a second. Please record your vote. Item is approved. Item number 3 this morning is to approve the meeting minutes from October 9th, 2025. We have a motion and a second. Please record your vote. Item is approved. Item number 4, 4A, is the presentation of the annual comprehensive financial report for the fiscal year ended June 30th, 2023 and 2024. Good morning.
Good morning. Good morning. My name is Deborah Duty, and I am the OSERS accountant, and I am here to present the June 30, 2024 year-end audited financial statements for the Oklahoma Employee Retirement System. I am pleased to report that overall, the system's financial position improved during the fiscal year 2024. The auditors concluded their audit on September 5th of 2025, and we were issued an unqualified opinion, which is the best that we can get. If you wish to read their entire opinion letter, it is on page 13 of your ACFRs. So these are a brief overview of the numbers as of 6/30/2024. I have marked your ACFRs so you can turn to the pages easier. On page 20 is the statement of fiduciary net position. So we have a net position of $883.1 million. And it increased by $40.9 million over the prior year, which was $842.2 million. This increase is primarily attributed to the recovery seen across the capital markets over the period. And if you look to the next page on 21, it's the statement of changes in the fiduciary net position. The trust had total contributions of $19.3 million in addition to a net investment income of $71.7 million. There were $48.1 million in benefits paid, which, allowing for rounding, that makes up the aforementioned $41 million. So if you turn to page 45 in the note disclosures, so for the current year, Due to the increase in the total pension liability, our funded ratio dropped slightly. We went from 91.88% to 91.34%. And even with that slight decline, we're still in a great position financially. On a final note, on page 99, there is an audit finding this year. Due to an error in the census data presented to the actuary, management has taken steps to prevent this type of error from occurring in the future. It was just a one-off because of the transition to the new software. So I want to give credit to the board for always providing our sound financial leadership over the years. Your leadership has enabled us to weather the uncertainties and enjoy the sunshine that follows. If there are any questions, I can answer them at this time.
Anyone have any questions on the financial statements for the last 2 fiscal years?
Okay, thank you.
Thank you very much. Chair will entertain a motion to approve the annual comprehensive financial report. Okay, we have a motion and a second. Please record your vote.
It's going to be one of those days. I would just,
It's still buffering, like we're waiting for a motion. Well, yeah, the motion's approved, but it doesn't show the vote.
why don't you go ahead and just call for everyone to say yay?
I'm going to call for, oh, what we got? Is it doing it? Is it working? Well, let's just do a roll call vote on this item so we can move forward on the agenda.
Hang on. I'll just turn my mic here. Trustee Madera.
Aye.
Trustee Nichols. Trustee McSpadden. Trustee Weller.
Aye.
Trustee Thurman. Chairman Bronson.
Aye. The item is approved. Okay. Okay, moving along, item 5 is the consent docket. We can take all those items with one motion. We have a motion and a second. Please record your vote. Item is approved. Scroll down here. Okay. Item 6 is to ratify approvals. We have 2 items. We have a motion and a second. Please record your vote. Item is approved. Item 7 this morning is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item number 8 is to approve the following applications for service retirement. We have a motion and a second. Please record your vote. Item is approved. Item 9, receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 10 is to approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 11, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 12 is receive report of death, authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 13, approve the following applications of vested rights. We have a motion and a second. Please record your vote. Item is approved. Item 14 is items for individual consideration. Item 14A is approve Gabriel Roeder Smith and Company to conduct an experience study analyzing actuarial assumptions for the Oklahoma City Employee Retirement System. If you remember, we spoke about this last month and a request was made. We usually do these about every 5 years, so we're definitely due for another study. And this is just approving our actuarial firm to start work on that experience study. Chair will entertain a motion and a second on 14A. We have a motion and a second. Please record your vote. Item is approved. Item 14B is approved growth equity fund commitment of $15 million to Warburg Pincus Global Growth 15. Good morning, Jason.
Good morning. So these next two items, this item and the next one, my colleague Joe Nugent, who's Director of Private Markets at ACG, is going to first provide a review of your private equity portfolio and private real estate portfolio, and then recommendations on these two funds that are new funds with existing firms that you've previously invested with. So I'll turn it over to Joe.
Thanks, Jason, and thanks to the board for the time this morning. So you should have some materials. Looks like they're in front of you, as Jason mentioned. We are in the process of making a recommendation for some new commitments here. As a reminder to the board, in terms of the private equity portfolio, we've been building this program over time. It started first in 2009 with a 5% target allocation. Over time, that has grown. In 2021, the target allocation was increased to 10%, and in 2023, the target allocation was increased to 15%. The current exposure in the portfolio is just under 10%, so we're continuing to move forward with new commitments, new investments, in order to move toward that 15% target allocation, hence the recommendations coming today. On the opportunistic real estate side, the target there is 5% of the portfolio, current exposure being 2.6%. So once again, we're moving toward that 5% target here with a recommendation to the new Starwood Fund. If you go forward to slide 7, a quick reminder of what our goals and objectives are with the private equity portion of the portfolio. The goal is very simple. We want to outperform public equity markets over the long term. We need better returns than are available in public equity markets. So what we've shown on this slide here is a comparison of the investments in your portfolio versus public equity markets. So very simply, what we do is take the dollars that were invested in private equity and instead pretend like those were invested in the public markets and compare the two. So did we do better by investing in private equity, or would we have done better if we invested in public equity markets? The pale blue bar there is the results of this particular program. So you see over the long term, both the 15-year and the since inception numbers, 13.6 in this particular case. The public equity markets over that same time frame using that methodology that I said, where results were 10.8 or 11.3. So the portfolio has benefited by over 2% annualized over that time frame since inception by taking those dollars and investing them in the private markets versus the global public equity markets. There's a listing of all the investments that have been made on the next slide, slide 8. You can see the detail on each of the commitments by dollar, how much has been called and invested over the history of this program. As a quick reminder, the structure of private equity funds is that you make a commitment, whatever dollar amount that is, say $15 million today is the recommendation for Warburg Pincus, and then as Warburg Pincus or whatever manager it is finds new investments, they call some of that capital and use it to buy whatever company they're after. So it takes time for them to do that, typically about 4 years for them to deploy all of that capital. And then when they sell those investments, they send the money back. So there's a constant ebb and flow of dollars getting invested and being distributed to the system. On the next slide, we put up a couple of bar charts or pie charts here that demonstrate some diversification measures that are really important. On the left side, we're trying to gain balance in this portfolio, balance by strategy here, so that we don't get over allocated to one particular area of the market that might get hot. So we want to make sure we keep one eye on that portion of the portfolio. And then second, on the right is a measure of commitments by year. You can see that in 2023, that's the biggest portion of the allocation. That's a result of moving the target allocation from 10 to 15% and increasing the new dollars that need to be deployed in order to move toward that 15% target. Other than that, it's reasonably balanced across time in terms of the new commitment dollars. Slide 10 is another visual of, we call it a portfolio construction map. Once again, it's an important portion of our risk control for this portfolio to balance our commitments to different types and styles of managers, just like in the public markets where you have large cap and small cap and non-US equity managers. In the private space, we have venture capital strategies, we have growth equity strategies, and we have buyout strategies. Each one of those is different in terms of its focus area and its scale. And we want to make sure that over time the portfolio remains balanced because these things roll in and out of favor and have different risk profiles. Early stage venture investing, where we have less relative capital invested, is a very risky area. It has great long-term returns, but it still has a high risk area. Buyouts, on the other hand, are a relatively more stable portion of the portfolio and will tend to have more dollars pointed toward buyouts than we will toward venture in most portfolios, the same way as we have more dollars invested in large caps, say, because it's a more stable place in the equity markets.
Joe, maybe just give some perspective on the differences in the number of companies that are owned by these different funds.
Sure. So Warburg Pincus, which is the manager we're going to talk about momentarily, their typical portfolio, their prior fund where your investors has about 118 underlying portfolio companies. They're actually in the new fund going to shrink that number down a little bit to about 80 to 90 portfolio companies. So that's one example. A CD&R, for example, in the large cap buyout space, they're sort of right in the bottom middle of that chart there. They'll have a more concentrated portfolio. They'll run about a dozen portfolio companies, only by 10 out of that. But each one of the individual managers across this graphic here has a different strategy, and each one will have a different number of portfolio companies, appropriately so. Firstmark Capital, up in the top left, in their seed fund might have 45 companies, but a lot of those won't work out. They're venture funds, and they need to drive returns from a small number of that opportunity set. So across all of this portfolio, if we rolled it up together, there's thousands of underlying portfolio companies. And that's part of the point, part of the risk control is that we don't have too many dollars in any one of these while maintaining the target, which is always we have to outperform public equity markets, so we don't want to dilute ourselves too far. So next slide is very heavy on numbers, so I'll take you zoom out. This is an internal analysis that we run. It looks at your historical investments, how many dollars you have committed to investments over time, what that could potentially look like on a go-forward basis, and the ultimate result of the analysis is to give us a number, which in this case is $35 million, that is the target for new commitments in every year. So that number helps us get toward that 15% target that we have long term and do it in a balanced way over time. The reason for that is we don't want to deploy way too many dollars in any one given year because you never know what's going to happen. There can be political events, there can be geopolitical events, there can be pandemics, there can be all sorts of things that affect what happens in any given market cycle, and we want to make sure and participate consistently across time. It's the best way for us to control risk across the portfolio because the number one thing, the number one decision-making tool that we and the board have is new commitment dollars. When do you deploy? How many of those dollars do you put in play?
I always want to caveat that this is dynamic. Every time we revisit making new commitments, we redo this pacing model. So it's not like an accounting budget where you're saying we need to put $35 million to work every year. It's right now as we're looking at this to try to make decisions as to how much to commit, right? What's a reasonable amount to commit? $35 million a year would be a conservative way to drive the portfolio allocation to 15% in 4 to 5 years. If, as Joe said, these events occur, it could be positive events, like public equity markets continue to rally and your portfolio grows at a greater rate than is expected, well, then private equity may not be growing at the same rate and the commitment amount would need to go up. On the other hand, if public markets sell off considerably and private markets don't, well, we're going to adjust that commitment pacing plan in the next year. So.
The second half of this is next slide. Slide 12 is the forward pipeline of opportunities. Manager selection really matters in private markets. There's a wide dispersion between good and bad outcomes in this market, and so we want to make sure that we're pointing all of the capital, all of the new commitments at the very best strategies and managers who manage assets on your behalf. So we keep a forward pipeline of opportunities. Many of these are already in your portfolio, prior versions of these funds, and then there's new managers that we always consider adding into client portfolios or recommending for client portfolios that would be complementary to things you might already have. So this is our short version of our forward pipeline list. You'll likely see some recommendations from us in the near term, not just today, but some of the other managers in your portfolio are raising capital actively right now. Our team's working on the diligence process for them for their new fund. As a reminder, again, each one of these funds opens for a limited period of time. They have a target amount of capital that they will raise. When they raise that amount of capital, they close the fund, and then they don't raise capital again, usually for 3 or 4 years. So we get ahead of that. We make sure that we understand where each one of these managers is in their fundraising cycle and position you to get into those funds as they open up. So we have a number of those on the forward pipeline, and you'll likely see some additional recommendations coming up in the near term. So that's the overview of the portfolio and the plan from 30,000 feet. Now we're going to talk a bit about
I have a question, if I could. Could I ask a question?
Yes, sir.
Oh, absolutely.
Yeah, looks really good, but I have a question on page 8.
Sure.
Now, the column on committed, that's our maximum commitment we've made to that particular entity, is that correct?
Yes.
Okay, and the drawn to date is how much we've put in. Is that correct?
That is correct.
Okay, on Firstmark COF, we committed $3.75 million, but we invested $3.84 million. And why did we send them more money than we committed?
So in that particular case, the management fee is outside of the committed dollars amount. So the 3.75 is investment dollars that they can deploy. And then there's an over and above for the management fee portion that they can collect. So that's why they're over the 3.75 million.
But that's also, I'm surprised we don't see it on other funds as well, Randy, because there's also a mechanism in these in the fund documents for all of your funds that if they distribute money back to you during the investment period, so you make a $10 million commitment, they call down $3 million in years 1 and 2, and then they distribute that. They get a realization. They sell a company that they bought for $2 million for $4 million, and they send that money back to you. They can recycle distributions in the early years, so you can actually invest more capital than you committed, or they would call it back. And so this is we're just calculating whenever there's commitment, whenever money goes out from the fund, we're putting that in drawn to date. And so it could be more than the committed amount.
Okay, thank you.
And there's a benefit to that, where you're able to invest more money than you commit, and you're paying less fees. You're only paying the fees on the committed amount.
Yeah, there's another important point to this slide as well, in that we report all returns net of all fees. And if you were to have any one of these managers in here, they would most likely show you a gross return number that didn't include that fee number. Well, guess what? We paid the fees. So that's part of why we show it like that. We want to show the net actual returns to the program, not some theoretical gross return number, because that's not what we get. We get the net return. So our performance group tracks that very closely.
Okay.
So Warburg Pincus, I'll speak off of slides 14 and 15. First of all, the Warburg Pincus is a manager that goes way back in the system's investment portfolio. The first investment was made in Warburg Pincus Fund 11. They're now raising their Fund 15. So you've been in 4 prior funds. Each one of those has had a little bit of a different amount of commitments, but if you aggregate all of the prior commitments up, you've committed $47.5 million to those prior funds. Of that, almost 43 of the 47 has been called and invested by Warburg Pincus. They've also sent back $35 million worth of distributions, and the value remaining in that portfolio is still $37 million. So a lot of numbers I just threw at you there. The big picture of that is if you aggregate all the investments you've made previously with Warburg Pincus, the total value is about $72 million net, or 1.69 times the dollar amount that you've sent to them. So for every dollar that they have invested on your behalf, they've turned that into $1.69. That's not a bad outcome. Very positive outcome. You'll see each one of the individual portfolio company or funds on slide 15 in terms of the performance results. I'm sorry, slide 16 is the performance results. Bottom of the page there is the PME. Once again, just like we showed earlier, the results of the entire portfolio versus the stock versus equity markets, we're showing Warburg Pincus specifically their results versus both the S&P 500, so large cap US stocks, and ACWI, the global stock index, each one of their prior funds and how they have done if you had made that same trade, if you give Warburg Pincus dollars or if you put dollars into large cap US or global equities. Their track record is very good and consistent of being able to beat global public equity markets. And once again, that's the objective. We're trying to beat what's available in global public equity markets. Warburg is a long-established manager, as you can imagine, with a fund number 15 behind the name of this particular fund. So this is the 15th time they have raised this particular strategy. The firm's been around since the 1960s. They raised one of the first private equity funds ever in the 1970s. It's a large global organization with a focus on growth equity, growth buyouts. So that means they're looking for growing businesses where they can add value of some variety and then realize those businesses, continue that growth, and sell them on our behalf. The leadership team's in the bottom left of slide 14. Jeff Pearlman is recently appointed CEO just in the last about 18 months. The former CEO, still there, moved to executive chairman role, Chip Kay, and then you'll also note Tim Geithner, former U.S. Secretary, Treasury Secretary, is also chairman there, has been at the firm for 15 years. Over time, they'll invest, as I said, it's going to be around 75 total investments. Most of those will be North America, predominance in the USA, but mostly North America. They'll do some Europe as well and a little bit of Asia. So we like that we get a little bit of non-US exposure, but the focus continues to be US-based companies. As I said, performance numbers, sector allocations, geographic allocations on slides 15 and 16. Last thing I'll say before we pause for questions, if there are any, is on slide 16. As I mentioned, you're in the last 4 funds in that list. So Fund 11, 12, GG is 13. They were superstitious about using 13, so they just called it Global Growth, GG, and Fund 14. If you go to the grayed out columns there, in each of those cases, you see 1.73, so that means for every dollar that you've given to them to invest, they've returned $1.73. The second fund there, Fund 12, they've returned $2.05, so every dollar has returned $2.05. 1.74 and then 1.30. So they've done a very good job of taking capital and compounding it for your portfolio.
So maybe before we move on to the Starwood Fund on the real estate side, we take up item, I think it's 12 or 14B.
Yes. Does anyone have any questions on item 14B? Okay, hearing none, Chair will entertain a motion to approve growth equity commitment of $15 million to Warburg Pincus Global Growth Fund 15. We have a motion and a second. Please record your vote. Item is approved. Now we have item 14C, approve opportunistic real estate commitment of $10 million to Starwood Distressed Opportunity Fund 13.
Great, thank you again. So I'll start off of slide 18 here and zoom back out to what's the objective of opportunistic real estate. We're calling this portion of the portfolio, which has a 5% target allocation, opportunistic real estate. So your portfolio has exposure to a number of different strategies, but many less than you have on the private equity side. This is a 5% target allocation as opposed to 15 in private equity. So the objective of this part of the portfolio, real estate in particular, is to provide diversification to the portfolio. It's not stocks and it's not bonds. Our expectation over the long term is that it provides returns that's somewhere between stocks and bonds. That's where its risk profile lies. Also, real estate provides inflation protection. You own hard assets, buildings in most cases. So those things go up in value over time because the value of the inputs goes up. The cost to build something goes up, which makes those real assets more valuable. And ultimately returns. The opportunistic portion of the real estate portfolio, the portion we're talking about today, has to do better than high quality core real estate. The managers in this portfolio take more risk. They buy buildings that have problems or vacancy or something that needs to be fixed. Therefore, we need higher returns for the portfolio. In this case, you'll see a bar chart again. This is just the opportunistic real estate portion of your portfolio. Zooming all the way to the right, since inception, that part of the portfolio has created 7.1% returns since annualized since 2013. It's about 120 basis points higher than you can get in the Odyssey Index. The Odyssey Index is a index of high quality institutional real estate assets managed on the behalf mostly of pension funds and other institutional investors. So it's a good proxy for what's the return of safe real estate in the U.S. So 5.9% for that opportunity set. Your portfolio has been doing 120 basis points on average better per year since inception.
It's worth just talking about that short-term dispersion relative to the Odyssey, Joe.
Sure. It's been a relatively tricky time in real estate. We're starting our recovery phase. We had a period where real estate was under a lot of pressure. That was driven primarily by the Fed starting to raise interest rates. On balance, when investors have a choice and interest rates are very low and real estate is producing income, which it does, real estate was more attractive. As the Fed raised rates, real estate became, on balance, less attractive and under pressure from a return standpoint. We're now at the other end of that cycle. So we see in the near term here, negative 5.9%, really trailing period returns that have not been very good. But the Fed is now starting to ratchet rates down. Real estate will start becoming more attractive again. And we have an expectation that if the Fed continues on its current path, real estate will turn the corner on its cycle and start returning, making positive real returns for the portfolio again. Since 2013, the program, the fund has invested $50 million into 5 separate real estate funds. You'll see on slide 19 a map of them by risk and return. On the right-hand side of the portfolio, you'll see the most opportunistic, the most return-seeking portion of that manager set, Singular Guff, Starwood, and Blackstone. Those are all opportunistic strategies seeking higher returns. On the far left, you see Morgan Stanley Prime Property Fund. That's a high-quality, stable, income-seeking real estate strategy. So that one stays in the portfolio permanently. It's an open-ended fund structure. All the others on the right are closed-end fund structures that require commitments over time, new commitments over time, just like we do on the private equity side. Slide 20, there we laid out a few of the largest investments for each one of these managers' portfolios. Starwood Distressed Opportunity Fund 12, which is the prior fund of Starwood, we're recommending Fund 13 today. The largest exposure they have in their portfolio is a portfolio of single-family homes for rent. You've probably heard about this strategy. It's institutional investors come in, buy a lot of homes in a particular market, and then rent those homes out to people who have a problem with affordability of homes. So it provides housing to people who can't afford the down payment to get into their own home, but would really like that non-apartment. They want their own home, they want their own backyard kind of environment. So they've aggregated up over 11,000 homes in that Fund 12. Some other examples of other things that are in your portfolio, Angelo Gordon's largest exposure there, industrial outdoor storage, is really a play on warehouses where there's lots of things. The picture in the middle there is a perfect example. Lots of construction and other industries need space to keep their equipment. Outdoor storage is the place where they keep that. It's been an institutionalizing asset class over the last 5 years, and they have a large position in that. And then Blackstone, another opportunistic real estate manager you'll see on the far right, sees value in the multifamily space. So their largest investment so far was take private of American Income REIT Corp, which has 77 multifamily assets across the U.S. Slide 21 is same thing we did in private equity, where we map out how many dollars do we need to commit on an ongoing basis to get to our target. The punchline here is the $10 million per year is the recommended amount, hence the recommendation today of $10 million commitment to Starwood. The details on Starwood are on pages 23 and 24. So Starwood's a Miami-based global firm founded in 1991. It's the same person who started the Starwood Hotel Group. Barry Sternlicht is the person who started this firm. This particular strategy is the strategy at the firm that does the most opportunistic portion of their investment activity. One of the things that we're big believers in terms of our diligence process is making sure that the managers add some sort of value. It's not just buying real estate, it's buying the real estate and doing something with it to make it more valuable. In this case, the focus is on leasing, repositioning assets. Oftentimes that could be a reflag of a hotel, changing it from a Motel 6 to a Hyatt or whatever that is. That can drive real value if you can get that done. Changing industrial assets to data center assets. One of the largest trends that is happening in real estate right now is the data center space. That's all driven by AI demand. It's all about getting power. They've found some really unique ways to get into the data center space by specifically repurposing assets that have existing power and then changing those over to data center usage. Think in particular, if there's an old factory that has excess capacity in terms of power because it's not operating at full capacity anymore, repurposing that power that they already have access to toward a data center. That's a very valuable commodity in today's environment. Track record is on slide 24. Here we don't have as long a history in terms of the system's exposure to Starwood, but you do have exposure to Starwood Opportunity Fund 12. That's a 2020 fund. It's performing very well so far. It's doing a 10% net IRR and a 1.2 times multiple. Over time, that'll get better. And versus peer group, the bottom here is a measurement of their performance versus peer group. 3 out of 5 of their last funds have been above peer median. 4 out of 5 on an IRR percentage return basis on the right have been in either the second or first quartile in terms of manager performance versus peers. Okay. So that's it. Questions?
Any questions on 14C? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved.
Great. Thank you so much.
Thank you, Joe.
Thank you very much.
Moving right along, item 15A is the monthly investment report.
I think I'm going to take these out of order, if you don't mind, and do the quarter, which is 9:30,
Okay.
and then I'll move forward. Just
That's fine.
a few slides out of the quarter report that I'll touch on. We talk a lot about, punchline is markets continue to go up. It's been, I guess, somewhat of a surprising year. We started out the year with a pretty significant decline in U.S. equity markets, 20% down in the S&P and small cap. With the onset of tariff notifications, moving into a bear market, only to see all of that wiped out, and really strong performance from both U.S. equities and non-U.S. equities. The challenge has been more on a relative return basis. Continues to be difficult for active managers, particularly in small cap, to keep up with the benchmark, as we've had pretty narrow leadership within large cap, although it's spread out a little bit. But within small cap, what we've really seen over the last couple of months is, as interest rate expectations were that rates would come down, you saw small cap stocks rally significantly in the benchmark. The benchmark now, and this ties to some of Joe's discussion on private equity, a lot of companies are staying private for longer. So the companies in the small cap public benchmarks tend to be lower quality and non-earners. Of the 2,000 companies in the Russell 2000, I think that 48% of them are non-earners, so pretty low quality. When the benchmark goes up, that rising tide lifts all ships. The Russell 2000 was up 12.5% in the third quarter. We saw active managers, the median active manager was behind the benchmark by about 300 basis points. So still up, but not up as much because they don't own as much of those lower quality names. So anyway, long story short, it's been a good year on an absolute return basis, a more challenging year on a relative basis. More importantly, as you just look at asset growth, focusing on the last 5 years, this goes back to just a little bit, I guess, really just to COVID, post-COVID, September of 2020, portfolio had dropped to about $792 million. Since that time, net cash flows of a negative $153 million. So that's contributions in from the city, less benefit payments and expenses out, which we'd expect that to be a negative number for a mature system like this. The growth, the return on investment from the portfolio, $330 million over that 5-year period. So at the end of September, you stood at $970 million. I think you're a little bit above that now. Just on a year-to-date basis, a little bit under $100 million in portfolio growth. So I know the financial statements that you looked at and funded status was as of June of 2024. I anticipate this is going to go up a little bit from that point in time. Relative to your stated objectives and your investment policy, this is just very black and white look, but I like to see all yeses here. So we're looking at not just return metrics, but also risk metrics. The one no is relative to the policy index. So you've on a 5 and 10 year basis, we've trailed the policy index a little bit. Most of this, or almost all of this we've talked about is because the policy index, 35% of the policy index is the S&P 500. You don't have 35% of your portfolio in the S&P 500. You've got a 20% target to large cap, and then 15%. That other 15% has been made up of both long-short equity and private equity. Today, that target is all private equity, but over the last decade, it's been a combination of those two, which don't track the public benchmark and don't track really the Magnificent Seven that's driven a lot of that return. So your more diversification has led to that bit of a lag. But more importantly, I'd say is the results relative to your real target, which is that 7% hurdle rate from an actuarial basis, over the last 5 and 10 years, significantly above that, which is what you need to get to pay your benefits and maintain and improve your funded status. That's what you're assuming. And then we always talk about risk. Philosophically, we say this portfolio has been built to participate in up markets and protect in down markets. We're not going to get as much of the upside, hence the 840 versus 843 or the 790 versus 879, but we should be protecting a little bit in down markets. And on a risk metric basis, we look at volatility or standard deviation, which is lower than the policy. We look at beta or sensitivity to the direction of the markets. We want a beta lower than 1, which means when the markets are going up, you're not going to be up as much. When the markets are going down, you're not down as much. And then finally, down capture, which is a direct measure of how much of that downside are you participating in. And it's well less than 100% over 5 and 10 year periods. And we certainly have, while the majority of the time has been up, there's certainly been periods of time over the last 5 and 10 years where we've had pretty significant declines, and this portfolio provides protection. Why don't we just move to the ASAP now, if you could, Mary Ellen. So just looking at the October report, the monthly report, the upper left, where we show returns of the broad markets on a year-to-date basis. One thing I think that stands out here is the two areas that have performed the best on a year-to-date basis are non-U.S. equities, both emerging markets and international developed. You see emerging markets are up 33%, and EFI, or international developed, up 26%. Not that U.S. markets have done poorly. S&P 500's up 17.5% year-to-date. Small cap, as I mentioned, up 12.4% year-to-date. Even bonds, investment grade bonds on a year-to-date basis up just under 7%. So you have a 7% return hurdle over time. Bonds are giving you almost that over this last year. So again, from an absolute return basis, very, very strong returns. As we look under the hood a little bit, and we drill down in your portfolio, While the emerging market return has been very strong, there's quite a bit of dispersion among countries. The best performing country in emerging markets by far has been China, which represents about 30% of that emerging market benchmark. China's up over 40% on a year-to-date basis. Your emerging market allocation between Allspring and Wasatch, Wasatch is a much smaller piece. It is small cap emerging markets. From a portfolio construction basis, they have very little China and a lot of India. And that has led to pretty significant dispersion from that piece of the EM portfolio. But again, it's about 1.5% of your total assets. From a valuation standpoint, we're not using this to be tactical, although it does factor in to our capital market assumptions on a go-forward basis that we review with you once a year in January. What this is indicating, this stoplight chart, is based on the current PE of that asset class, the current valuation price to earnings, how does that compare to the average of that asset class over the last 15 years? So red is overvalued. We'd say it's expensive. That PE is above the average PE over the last 15 years. Yellow is fairly valued and green is undervalued. Not necessarily a good predictor of how performance will be over the next 6 to 9 to 12 months, but it does factor into our long-term 10-year and plus capital market assumptions. So as we see something that is overvalued, our capital market assumption for next year for large cap is going to come down a little bit. Our capital market assumptions for the other asset classes will probably stay about the same, but not surprising to hear that large cap continues to be a little bit or quite a bit overvalued relative to historical, but it continues to generate return.
If you broke out large cap in terms of growth and value, how would that look different?
Oh, it looked very different.
Yeah.
Growth would be significantly more expensive.
I'd heard it's at a 50-year high or something like that in terms of.
For sure.
Okay.
And I think the other, this isn't necessarily asset allocation, but just portfolio construction and implementation, thinking about if you're implementing passively, the S&P 500 is probably not a core benchmark anymore because of the weight of some of those growth names in the benchmark. It's decidedly biased to growth. So you may have a little bit more weighting to growth in the higher value names than you'd expect. From an asset allocation standpoint, where we are today relative to targets, a little bit overweight to equities. That's really the underweight to real estate. Joe was talking about the opportunistic real estate. Overall, the real estate or real asset target is 15%. We're about 2.5% underweight there. Most of that is in the opportunistic real estate space, which it'll take some time to get there. Within equities, we are underweight the target to private equity. It's going to take some time to get there, but those assets are being held in public equities, both large cap and small cap and emerging are a little bit overweight. We continue from a risk management and rebalancing standpoint. Large cap has been and continues to be the source to raise capital. We just, Matt's not here, but I think we just raised, I want to say $16 million to move into cash for operations, benefit payments, and capital calls to cover to the end of the year. So that number is coming down, and that's our primary tool to do that. From a return standpoint, on the year, the trailing 1 year, this would go back to November of last year to now. I'd say all these numbers, net of fee numbers on a 1, 3, 5, and 10-year basis, well above your hurdle rate of 7. So really strong absolute returns relative to the policy benchmark. Again, this is not having as much S&P 500, which is 35% of your benchmark. It's the areas particularly private equity in the short term, you're getting positive returns. If you look at a 3-year basis, an 8.25% return from your private equity portfolio, but we're comparing that in the policy benchmark to the S&P 500 in the short term, and it's not going to track along with that. Longer term results are strong, and it's been additive. Nothing really else to point out here. As far as any individual manager issues, I know I talked about small cap and the lower quality outperforming. It's not so much a quality issue, but you're on the growth side, Silvercrest, while they are looking for earners, they will, on the growth side, invest in some of the more speculative names, and some of what's hurt them has been being in the smaller end of the market. You'll see when small cap rallied, particularly over the last quarter, it's not necessarily reflected here. If we looked at the 3-month, that's really driving this. They're now up almost 200 basis points ahead of the Russell 2000 growth, whereas if you recall, you may have looked at them in the past and they were behind. So they've actually benefited from the decline in rates and a little bit of a lower quality rally in small cap. No specific manager issues or concerns at this time. As I mentioned, we're finalizing our long-term and intermediate-term capital market assumptions for 2026. I anticipate they're going to come down a little bit from last year. Still believe a 7 to 7.5 hurdle rate is going to be a reasonable probability of achieving that going forward. Not looking in the rearview mirror to tell us how we're going to do going forward. We're looking at where we are today. And so we'll look at that at the beginning of the year in January.
Okay. Anyone have any questions for Jason this morning on either of the reports? Hearing none, Chair will entertain a motion on item 15A, which is the monthly investment report. Have a motion and a second. Please record your vote. Item is approved. And we'll entertain a motion on item 15B, which is the quarterly report. We have a motion and a second. Please record your vote. Item is approved. Item 16, comments from board, staff, and citizens. Just want to wish everybody a happy Thanksgiving, and hopefully you're all staying home so you don't miss your flight or get it canceled. But hopefully things will be back to normal here in the next week. So we'll see everybody in December. We are adjourned at 10:58.